A few months ago, I did this one video, The Death of High Inflation, where I argued that a lot of people are saying that, hey, you know what, with QE, we're not getting that much inflation. We're not getting the hyperinflation that Schiff's talking about. And what I was trying to argue in this video is that down the road, based on these policies, if we continue to do this, even though if we raise interest rates a little bit at a time, guess what? When banks start lending, that's when that nasty inflation is going to pick up, right? You have low taxes, or you see cutting of taxes, you see banks starting to lend, they get an incentive to lend because interest rates go up, then that's when we're going to get in trouble. And I stated that, hey, you know what? It could be a few decades before we get this. And I want to turn to this one comment by this one trader. His name is Cosmos Gato. I think he's a trader based on what people told me. This is what he said. At what point is it clear you have an incomplete/flawed understanding of economics? Saying you'll be right in some distant future is utterly useless. And I can usually tell who's a trader and who's just maybe a middle of the road average guy. And this is what I want to do the video on, actually. And this is going to be about traders or Wall Street guys versus gold bugs. And I think this individual was on Wall Street or is from the New York area. Can't confirm that. But I'm going to show you what our financial system's all about and compare it to gold bugs. And now I want to turn to this one article. It was reposted on the Business Insider, and it's called Long-Term Thinking Has Died. It's by the Motley Fool, though. Long-term thinking died on Tuesday. His last true friend, Vanguard founder Jack Bogle, was at his side. He was 213 years old. Long-term thinking lived an illustrious life since the start of the Industrial Revolution, when for the first time people could think more than their next meal. The final blow came Monday when a trader on CNBC warned, which has occurred on average every 11 months for the last century. It could be devastating for investors. That's it. Long-term thinking whispered from his hospital bed. There's no more room for me here. He died soon after Bloomberg published its daily tally of how much the net worths of the world's billionaire changed in the previous 24 hours. Long-term thinking endured the Great Depression, World Wars, and spiking interest rates in the 1980s, but the last 5 years proved too much. As he fought for relevance with cable news, Twitter, and derivatives, he was hospitalized in May 2010 after pundits lost their collective minds over a flash crash that made a few stock prices freeze up for 17 minutes. And then it goes on and on about this story. 50 years ago, the average stock was held for more than 8 years, according to LPL Financial. By 2010, the average stock was owned for for 5 days. 15 years ago, S&P 500 companies spent more than 40% of available cash flow on capital investments. That just fell to 25% by 2007, with the difference going most of the share buybacks, likely to boost option-based compensation. Our culture has an endemic problem of short-term thinking, Long-Term said in his final speech in November. Years have become months, months have become days, days have become milliseconds, and milliseconds have become careers. However much more you're winning in the short run, you're losing in the long run. And I want to go about it and how the investing community has changed over the past 50 years. And you could say longer than that. And you see a lot of more people just starting to trade. That's how the culture is on Wall Street. And sure, they traded back in the day as well. Don't get me wrong. But at the same time, you had many more people hold stocks for longer periods of time. It's a different culture. Now, people don't want to buy and hold for long periods of time because they see asset bubbles form every 8 to 12 years. You saw the asset bubble crash, you could say, in the 1980s. The SNL thing blew up. You also had the crash of '87. If you want to go to 2000, tech bubble. 2007 real estate bubble. What's the bubble that's going to blow up next? China within the next few years. So that's why no one really cares about the long run. And these are mainly traders. And I understand the trading perspective. You want to make the most money possible. And sure, you're going to have to pay more in taxes with short-term capital gains, but if you are able to shift money from one industry that is boomed to an industry that is in a depressed area, then you can make a tremendous amount of money. I understand that kind of thinking, and I understand it now because I start to trade a little more. But you want to now look at gold bugs and see that they are mainly long-term thinkers. And if you want to look at what many gold bugs subscribe to, they subscribe to the Austrian school. I'm on the Mises.org website, and this just promotes Austrian economics, what Ron Paul talks about, Peter Schiff, and list goes on and on and on. So if you see a lot of people on YouTube, right, they subscribe to this vision. They subscribe to long-term thinking. Some of them thought, even like myself, that gold and silver would go ballistic to the upside. But we've all realized that, hey, you know what, markets don't go up in straight lines. And I could show you another quote of how these individuals think, or people who follow the Austrian school or gold bugs think like. Alright, and I wanted to end this podcast by looking at what I looked at in that Peter Schiff video that I did about high inflation, the death of high inflation. And this will give the insight of gold bugs. And I can start from right over here. They're just talking about the gold standard and what was going on in England in the 1800s. And this was talking about some of David Ricardo, free market economist in Britain, some of what his plans were and how the establishment rejected his ideas. And we could start now, and I could tie it into the gold bug versus Wall Street analogy. Third, Ricardo and many of his followers not only failed to address the questions uppermost in the minds of the practitioners, but failed to make clear that they were not addressing these questions. Ricardo's analysis is almost entirely long-run comparative statics, and his policy recommendations consisted mainly of a set of rules for restoring and maintaining convertibility of pounds into gold at a fixed exchange rate. Important as his work for economic theory, it gave very little guidance to the Bank of England on the issues of greatest concerns to its directors. The governors and directors of the Bank of England were concerned with the profits of the bank, the avoidance of panic, and the appropriate response to short-term changes. For example, an increased demand for borrowing by the country banks or from banks abroad. So this, or the last few sentences, hit the nail and what I'm trying to get at. We have many individuals who are traders, right? They could care less about what gold bugs or what free market guys like Ricardo's talking about. They're talking about the long run. They're talking about the big picture. So whenever you talk about individuals, mainly on YouTube or Schiff or Ron Paul, they're talking about the long run. And you got all these guys on the mainstream media, and you have traders, they only care specifically in the short run. Because some of these individuals, not to pick on anyone, they're like, in the long run, we're dead. That's what Keynes said. So if you want to look at the psychology between traders and gold bugs, or Wall Street individuals and gold bugs, Wall Street individuals are judged within 90 days performance. Gold bugs, a lot of them don't trade. A lot of them have 9-to-5 jobs and usually think about the long-term picture. But what's happened in the last few years, a lot of us believe that we're going to see that nasty inflation occur right away. And I initially was saying that, and now I'm starting to doubt a little bit of what I said is because of what's going on in China. And in my opinion, China is going to be the next shoe to pop, and if that pops, that's going to give the United States more time before SHTF. Ultimately, I still agree with the long-term thesis of what many individuals on YouTube are saying, that if we continue the road of running all these high deficits, trade deficits, and quantitative easing, keeping, and eventually we're going to get out of QE, in my opinion, and we're going to try to raise rates. When you see rates go up, banks start to lend, then you see maybe cutting of taxes. All that money on the sideline is going to pick up. And since they lend that out, oh boy. I hope I don't see the nasty inflation, but in that scenario, I wouldn't be surprised. And it could take some time. I've stated that. But I'm just looking at the long picture. And forecasting the amount of inflation down the road within 5, 10, 15 years is difficult. Even Mike Status, great forecaster, can't forecast that. He stated that in one podcast I was listening to him. So that's something to note. So big difference between gold bugs and Wall Street individuals. Wall Street individuals I also put in as traders. So whenever I look at some of these videos on YouTube, I could obviously tell who trades, who's a trader, and who's usually a long-term thinker. Anyways, guys, that's something to know when you watch these videos, like who trades, who doesn't, who's in between, and then you could understand the psyche of how these guys operate. They operate on a day-to-day basis, these traders. Gold bugs, they're usually in it for the long run, the way that I see it. But some of them thought that this is a lottery ticket, and a lot of them will actually be surprised about that. Anyways, thanks for listening to me, guys. Talk to you later. Bye.